If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
Hey, Bruce, welcome to the show.
Hey, thanks for having me on. I'm really excited to be here.
I'm excited to have you. We did a little talking beforehand, and I think we're going to have a really exciting, engaging episode. But before we get into the fun stuff, not that your origin story isn't fun, but if you don't mind, just share that with the audience.
Yeah, I'm Bruce Wuollet with Bakerson, and I like to share with people I'm an SOB. I'm a son of a baker, and that's where the name comes from. I grew up in a bakery business, worked for my dad back started in the 80s. Started when I was really young, and I know I look younger than I am. So I was in the bakery business, left that, did a few other business ventures until right around the year 2001, got into real estate, tax lien foreclosures, then got into buy, fix, and sell single family homes, got into wholesaling before wholesaling was really a thing. I did that in Phoenix from 2003 through 2007 and 8, got into a land deal, took some pretty significant arrows in the assets during the crash. And then we got back into wholesaling houses till 2014, 15, or 2013. And then 2013, 14, 15, started wholesaling multifamily. And then we started repositioning multifamily in 2015 as operators, taking down, we've done 19 projects full cycle, mostly small, 6 to 120 unit buildings. And then currently we're doing the buy for the long, for the long hold, for the long run.
Oh, that's awesome. That's a long time you've been in the business. So I'm sure you have a lot of war stories and fun stories to tell, but I'd love to get in the conversation of why did you switch from more of like the, wholesaling, quick turn, quick sale into the more long-term buy and hold strategy? Why did you make that change?
Well, when we were wholesaling houses, we were doing the door knocking, the yellow notes. And then in 2009, 10, 11, 12 were really good years for wholesaling. We were doing, between 200 to 200. I think our biggest year was 287 homes that we flipped in a year. And we took them down, did this make them city zoning compliant. So there's no zoning ordinance violations or anything like that. Make them violate, board them up, get rid of graffiti, clean up the yard, do trash outs, things like that. So it was kind of wholesaling. We would wholesale them, but we would actually take them down. We weren't always flipping the contract. But as the internet came in 2000, internet's been around, but as it came into the wholesaling world, people were able to offer much more services than we could. And for a very low fee, they were providing a drive report, providing a title insurance, a loan, and everything, that they really got ahead of the game. And we didn't jump on that bandwagon. I said, you know what? I like the yellow notes through the neighborhoods. And as those vacant properties were getting swallowed up and the REOs were getting swallowed up, we ended up going to the auction. And then that became systematized through the internet. And we had a hard time competing with some of the bigger players on that. So then we said, hey, we can wholesale multifamily. So we started wholesaling multifamily, did 24, 25 apartment complexes. We just flipped the contract and then decided that, hey, we could probably fix these up and sell them. Look at how we can do that. So started doing some strategic partnerships, did a 64 unit was our first building and 120 unit was our second building. And then decided that, hey, we can actually do this without a partnership of 7 people. We can kind of do it on our own. So we bought a 22 unit in Glendale, 16 unit in Phoenix. And then after 6 projects in Phoenix, the market was getting kind of hot. Investors were not really excited about the numbers, and they've gone crazy since then. That would have been 2017. 17 went into Tucson, and we did 11 projects in Tucson. And now we're expanding into Southern Arizona, Albuquerque, and DFW markets. So awesome. The transition. So when the transition is mostly by just the lack of leads, as you got less leads coming in, we had to do something to keep the business going. And because we're, as operators, you're always unemployed, right? You're always finding the next deal if you're in a flipping business. And anything under 24 months to me is still in multifamily is a flip. It's not really even though investors are passive income for the IRS. To me, that's not passive investing, because every year they're looking for a new place to put their money. That's a pretty active role as an investor. And we're always looking for new deals. So I'm thinking, you know what if we could find deals, but instead of selling them at a prime, we get a long-term financing in place and we keep them. We keep the prime as a long-term hold and buy cash flow. So we're not buying appreciation now, we're buying cash flow, and we like appreciation, but that's not what we focus on.
Yeah, let's continue that conversation, because we do the same thing. We're buying for cash flow. Obviously, if appreciation comes, that's great, but cash flow can, weather you through storms if you're buying right and operating right. But, the typical syndication, it seems to be like 3 to 5 year hold for multifamily, large multifamily deals. But is that what you're doing when you're talking about long-term hold? Or are you talking about like longer term periods? And if so, how are you getting your investors to buy into that? Because what I know a lot of people do is a 3 to 5, and that's what the investors like. But you're 100% right, where that's not really that passive, especially when you're getting closer to 3 in less years.
Yeah, well, a lot of the syndicators here in Phoenix are doing 18 to 24 month models, and they're even shorter because the fast appreciation and the fast repositioning, they're really getting good numbers, and they're hitting those numbers, and they're going to get it for a while. But at some point, that valve is going to turn off. And it's good to know, how are you protected as an investor and as an operator. So I tell people that 18 to 24 months is not passive investing. That's active investing. Buying cash flow is passive. And I ask the investors that, why do you consistently put the operators out of work, the sponsors out of work? So because if I sell a deal and the markets are jittery, the savvy investor say, you know what, I don't know if I want to get in the next deal. Let's kind of wait to see where this is going to go. Or if we have a cash flowing property and the market's jittery, they're like, hey, Bruce, look at the market's getting jittery. That's okay, because we're not selling. We're cash flowing. We got a good loan on here, a good cash flow. We're very protected. We got good reserves in place. We share the financials. And at that point, when things are jittery, as they kind of have been with interest rates, investors are going to want security. You don't want to be the rock in times of uncertainty. And so that's kind of what we did. But Shawn, the challenge we have is that, and I'll give you a little secret, the fastest way to shrink your database is to go from a 3-year hold to a 7 to 10 year hold. All you get is crickets. And I found out crickets don't have money. So,
Yeah.
So you asked, how are we working with the investors? We're building a new investor base. And that has happened more than once. When I was doing wholesale houses, then we were taking them down. I was getting investors that were putting up 100% of the money. We had flip it and do a profit share. We were making pretty good money as flippers, and they were making 50, 80, 100% return on their money in the course of a year. And then we turned it into the buy, fix, and sell, or I'm sorry, the multifamily. Then we switched over to buy, fix, and sell apartment buildings. Many of those went away because they were getting so much money. They didn't want to do a 15 to 18% return, because a lot of them were hard money lenders and active investors, so they could make money somewhere else as well. So we shrunk our database, and then we switched to longer term. We shrunk it again. So I'm very good at shrinking investor databases, and I'm working on how to build it back up with passive long term and be in it for the long game. And it's not an easy conversation necessarily, but the biggest thing is there's a sea of change coming. When is it? I don't know. 3 years. We seem to have a lot of good metrics out there. The economy is good. The government's dumped a lot of money in, but when you dump money into the market, that's what inflation is. And when the prices go up, that's a result of the inflated money supply. So people think inflation is increase in prices. Well, actually, increase in prices is a result of inflation. Inflation is when they inflated the money supply, because if you have more of something, it becomes less valuable. And there's more money in the market. The government's printing money. And so we're going to see this 8-10% inflation for a while. And we're going to have to pay for that somehow.
I agree. And I feel there's going to be a wave of more longer term investors once they see that period, when we see some type of correction and they're not able to get the returns that they normally have gotten, but they see these passive investors who are in a longer term strategy still getting that same consistent return year after year. But obviously, like you said, I don't know when that's going to happen, but when it does, I feel that's when we'll see the influx to this type of strategy. But have you seen any type of patterns, or where you should be fishing to get these type of investors currently?
The investors that we've had, there's a couple of investors. One is one that I actually connected through LinkedIn that invested in one of our projects, and he said that he got like 25 or 28%, some big return, in the 20s on one of his projects. And he said he was really excited until he got the check and then realized, man, I had to go find another investment. And he spent a couple of months looking for another investment. And he said during that time, he realized that those 2 to 3 months, whatever time lag, when he's looking for the next investment, he's busy as a business owner, that he didn't have time to, and all of a sudden that money's sitting in the account, not getting a return. Well, now he's watering down the return that he had. So he had a great return, but too many months of zero interest eats away at that annualized return for the next cycle. So he says he would rather get, 10, 12, 13% over the long term than to get, 18, 20% and then have to go find something again and then find something again. So that's one type of investor. Second one we're finding is there's a lot of professionals like doctors. They're busy with their medical practice and they want a place to put their money that it can grow, but they're not so excited about the stock market, or they might have some in the stock market and have some in an IRA and some in a 401k and wherever else they might put it. They have these different vehicles and they want to put a percentage of it into higher growth, higher perceived risk equity plays in real estate. So most of them are professionals that are not active in real estate, but they have a high interest in it.
Yeah. And I think a lot of people forget that it's not timing the market, but time in the market. So I think that's a great point to highlight that. Yeah, your return is going to be watered down even if you get a 28% return, but you got to wait 2, 3, 4 months to find the next one. It's watered down, especially with inflation, right? It's just eroding every day.
And that comment you just said that this time in the market, I've heard that like probably half a dozen times the last 2 weeks in different people I've talked to. So that's a pretty heavy buzzword right now. So there's a lot of talk about how do we to weather through the next cycle. There's no question. And then the other thing to do is to buy on fundamentals. People buy on appreciation. They're buying on pro forma, selling on pro forma. And that's fun when it can work, but that's really an adrenaline rush, but it's also high risk because we buy on actuals and sell on actuals. And so we're a minority right now, and that's okay. That's because we buy fundamentals. That's really what we should do.
That's what you should do. And I agree on that. And that, it makes it harder to find a deal. You got to look at a lot, more frogs till you get that print, but hey, we can sleep at night. I agree. So in terms of rates, you've been in the business over 20 years. You've seen a few different rate cycles. What is your thought? Like personally, my background, we didn't talk about this. My background's in finance and I worked for one of the larger fixed income shops on Wall Street. And so knowing the bond market is important for real estate in general. And currently what we're seeing is the bond market seems to be having rates priced into about 3% by the end of next year. Whether it'll hit there or not, we don't know, but that's where it's kind of priced in. What is your thought and where do you think? And but when I say 3%, I'm talking about the Fed funds rate, where they're raising it and where the 10-year could go. What is your thought on that? Where do you see rates going?
Well, I see rates increasing. Now, how fast they don't want to kill the golden goose that's printing money I shouldn't say printing money because they're actually printing money, but that's creating wealth in the markets. But the inflation is so high that we certainly need to stop that flow a little bit, and that's done through an increase in cost of money. So it's a delicate dance. So I believe they're afraid to do too quick, because if they do go too fast or too high too fast, you're gonna really hurt the economy, and then that's another issue that we just came out of with the COVID blip. They dumped a lot of money in, so I see that. But also with the rates when the rates were sub 3, sub 2, it's not really a healthy place, I don't think, for it to be that low. When you're getting adjustable rate mortgages at 2.5 or 2.75 on loans, that's almost free money, and it just didn't seem sustainable. Of course, I don't have a finance background, and I didn't follow the interest rate as closely previously, but I know that the cost of money has continued to come down. Well, now when the interest rates go up, there's two things that I see happening, and only time will prove it out, right? So this is my theory. This is not any advice. This is only my opinion, and I'm not an economist. But what we're seeing is the interest rates are going up, but we're seeing the cost of equity actually coming down a little bit, and then the increase in rents are going up. So the increase in rents and the drop in the cost of equity from a 18 to 20% to a 12 to 15%, will make these deals, the prices still continue to rise in certain markets for a time, probably, as long as the interest rates go up gradually. I think we'll still see for the next year or two a rise in prices. And I'm not saying a rise in value, because the inflation is eating away at the rise in value. It's a rise in price. The value is, who knows, right?
Right.
With this new math. But as soon as the investors start saying, I'm not going to take any more money, I'm not going to put any more money, equities, and put money into the marketplace, I'm a little concerned about this interest rate. Until then, we're going to see a rising market. And one thing that I think is vitally important as operators that I'm seeing people aren't doing a very good job at, is increasing their expenses. Expenses should be going up. If you're $3,500 a unit annualized for your your expense account for your properties, you got to bump it up to over 4,000, up to 4,000. You have to put over 10% for sure, 10 to 15% increase in that, because the cost of labor is going up, the cost of materials is going up, and the supply chain is causing you to have vacant units longer when you can't get supplies in. So be realistic on those numbers. And that's all I encourage, is to stress test them with a little bit higher expense per unit. And I think you'll be in a safer spot too.
That's a great point. And to continue on that theme of underwriting and rates, over the past 8 months, bridge debt was very hot. And that's what almost everyone was using. And why wouldn't you? You're getting, sub 4%, in some cases, even sub 3% debt. They'll finance your CapEx up to sometimes 100%. Why wouldn't you? But now things have changed, because we know we're in a rising interest rate environment. And for listeners that aren't familiar with bridge debt, it's a type of short-term debt where you acquire a property, and yet generally the terms are going to be usually 2, and then you can add a year and maybe even another year, and then you have to refi into something more long-term. So the risk there is that in a rising interest rate environment, you're going to refi into substantially higher rates. So the question here is Bruce, I've been talking to brokers, and people are still using bridge debt to this day. And what is your thought on that? How we're not underwriting bridge debt right now. We're underwriting agency, and when we have to, if we can only get a 60% LTV, then we'll bring in a pref to get that LTV up. But in your opinion, how are you underwriting, and what do you think is the best way to attack that in the current environment?
Well, it depends on the asset that the property that you're buying. It makes a big difference. If it's underperforming and you want to get it performing before you can get a good agency or life insurance, type of a debt, a more permanent financing in place, there's still a spot for bridge debt. And we're in the middle of application on bridge debt right now. Now, adjustable rate mortgage looks really, really appealing because you get it low, but you need to buy cap insurance if you want to protect yourself, right? And cap insurance went through the roof. It went from $60,000 a unit, $60,000 for our project, up to $382,000 over the course of a few weeks, and then drop back down again. I think bridge debt's still a good vehicle, but just be conscientious of the exit rate. And the exit rate isn't only for your own debt, but when your buyer, if you're selling, your buyer needs to come in, and an increased interest rate will also increase the cap. Now, when I first started underwriting deals in Phoenix 7 or 8 years ago, we were at an 8 to 8.5 cap was considered normal for CC minus properties. Now CC minus properties are trading at, selling at 4 cap on pro forma. So it'll go back up to, I think 6 or 7% on actuals is really a stable market. Now, when that happens, I don't know, but those days are coming in the future, next 3 to 5 years. When the cap rate goes up and interest rate goes up, your values are impacted. Yeah,
agreed. And that's the important part too, that people aren't realizing. Even if you're getting bridge and you're not going to refi and you're just going to sell, it's going to take a hit on what you can sell it for, because it's going to be based on what that new owner can get financing at. So that's a great point. Yes. that you bring up. And yeah, we've been in conversations going back and forth, bridge versus agency, and you're right, it does depend on the project itself. But I appreciate you sharing that. But in terms of, do you have any other underwriting strategies or tactics you've changed because of the current environment?
This isn't part of underwriting, but it's part of process. Because of the supply chain challenges and finding certain things, like there's just weird things that are missing, so that you can't get a range, or you can't get a refrigerator or a microwave. There's just certain things. So what we're doing now is, when we're turning units, we're making sure that we have everything in-house, purchased, ready to be installed prior to demoing a unit. Because if you're short some things, you could keep it at the low, like a classic unit, keep it classic for another year or a 6-month lease or something, but put somebody in there, because keeping it vacant while you're looking for materials is very, very costly. It's way more costly than waiting a year to update the unit. So our materials and project manager is on top of the details and pre-buying. So once something is vacated, everything is in place that we can go in and do a quick turn on it. Because that, when you're updating the units from a classic to updated, you got to be conscientious of that. And the other thing is we're seeing the costs are just in certain materials are through the roof. I mean, electrical wire is insane. You know, I bought some for home, $50 or 50 feet of 12-2 electric for our island, and it was $80. I'm like, this is, that gets really expensive. So there's all these supplies. People are going to be surprised when they go to, if they haven't done a project in a while, the prices have gone up, and they'll stabilize at some new norm. So those are the things with underwriting. The other thing is, I would encourage to write your rents at 3 to 5% max increase in rents over the next couple of years. We've seen some underwriting come across our desk recently from operators here in Phoenix that have 10% a year for the next 3 years still for 2022, 23, 24.
And that's just organic growth? Yeah,
10%. And I don't, to me, that's just making your numbers work. I mean,
wow. Yeah.
Some of these people have spreadsheets. Like a friend of mine teases that, he says, man, my performance looking so good that even I believe it. So you got to be careful on the underwriting so just be conservative, underwrite it at 3 to 5 in a bigger market, 2 to 3 in a tertiary or smaller markets. Just be reasonable. Don't get carried away. And if you do see 10% growth, that's not your work. That's the work of the market. And then celebrate that with your investors at that point.
Yeah, I couldn't agree more. Yeah, and it's why people continue to outbid one another, because they're doing that. Like you said, they're making their numbers work,
and they'll probably hit them in the short term, which is
right,
which is really difficult. But eventually, that train, like I said, that merry-go-round is going to stop.
Yeah,
and we're not sure where we're getting off. Right, the train's going to stop.
And there comes to a point where people simply just can't afford to pay what you're trying to raise rents to, and that inflection point will be reached. Whether it's this year, next year, or a couple of years, who knows? But we will get to that point, especially with.
So which markets are you in right now?
We focus Georgia and the Carolinas.
And so one of the things that we're seeing, and this could be a whole nother topic, a whole nother show actually, is the underserved. I believe the largest demographic, fastest growing demographic, and the most underserved demographic is the lower middle class and the upper lower class. So the people that are self-paying residents that are right above they're above the poverty, they're not getting subsidized rent, they're not getting Section 8 or other programs, voucher programs, but they're self-paying and they're working in in the trades or in the local retail, things like that. They need a place to rent. They're getting outpriced. So they're moving further out into the suburbs. But the cost of gas and fuel right now is so expensive. And then, so they're looking for jobs more in the neighborhood. They move out and then they find jobs there. And it's tough to find employment in near the city hubs for the lower skilled workers. I don't want to call unskilled because everything has a skill, but the entry level jobs and the lower paying jobs, who's going to commute an hour for that to go work in a restaurant? They want to live in the area that they work because the cost of transportation is so high with fuel. So those are things that, how can we serve that demographic? And I think we're going to see those ones get outpriced. And there's going to be a huge supply of people that have places they can't afford. Just to touch on what you just talked about, they can't afford to live there. When the rents went from $800 to $1,200, they're not that residents any longer.
Right, exactly. Yeah, and yeah, it's going to be interesting to see, and if there's going to be any trends of where people, move, or if then places where people were moving from start to give concessions, and if you see people move back to where they came from, it's going to be interesting to see. But I think that goes to your point of underwriting conservatively, not with some crazy rent growth rate that, like you said, may be able to be obtained now, but not in the future.
Yeah, so. Yeah, buy it because it's a good deal today, and then reward everyone because the operations have done well, the market has gone up, inflation has kicked in, rents have gone up. Now you can celebrate that victory. That, hey, good thing we bought well at the moment because now we're doing even better. but don't buy just to buy. That's a very dangerous place to.
I think we're seeing a lot of that now. The cliche saying of FOMO, fear of missing out. I think that is a key part of it. People obviously it's a great investment, multifamily real estate, but I feel like there's a lot of that where people just feel like they need to buy something.
Well, that's where when we're buying, if there's a call for offers, if they say, hey, we're gonna do a call for offers and we're gonna go highest and best, I have lost on those 100% of the times. We have never purchased a property that went to highest and best and final. What we do is we'll ask the broker that, hey, what number do they need to not go to highest and best and final? We went to this property the first round and they said, okay, you guys made it to the second round. They said, what can we be that this is the final round? What number do you need? And they gave us the number and we agreed to it and we bought it. But that's otherwise, if they had said, no, we're taking to market, full market, we're going to get a best and final. We just don't compete with that, especially in this current market cycle. It just doesn't make sense for our model. No, it might be a good business model. It's just not our business model.
Yeah, that's smart. We're currently in one right now that we're going to best and final. I know we're not going to win, but when you're building a relationship with the broker, you play the game with them, right? So you still submit, but
absolutely,
I know we're not going to win, right? Because from the beginning of this one, it's a great asset. It's sad that we couldn't preempt it, but from the beginning, they said the seller wants it to go full cycle. So, yeah.
Well, I encourage as sponsors and operators and buyers that you would always take it as far as you possibly can with your numbers, because that relationship is hugely valuable as the market changes, or they come up with a deal that says, hey, this guy doesn't want to take it out to market. He doesn't want the publicity. He just wants to quietly sell and move on. There's a lot of operators like that. There's one that we're trying to get numbers on. The owner does not want anybody. He wants us to prove that we can buy it because he doesn't want the managers or the residents to know that he might sell. He's a long-term owner, and he'll sell to us if we can prove that we are capable of buying it. So he wants everything up front. Well, I have trouble with sending proof of funds to a stranger, and all that. So, but sometimes that's what you have to do. So you're right. But taking it all the way to best and final, as long as the broker keeps putting you in front of the seller, keep doing it, because it's a great relationship and great underwriting skills.
Yeah, exactly. It's just one of those things you got to know that, this is not the one we're taking down, so you don't get your hopes up. But yeah, it's just an interesting market, and you just got to play the game. And now, we continue to get, quote unquote, putting the air quotes up here, off market deals from brokers, right? Where they say it's off market, but we continue to get those. At least those you can preempt at the right number. So that is I'm still seeing that in our market. I don't know if you see that as well.
Well, we see that absolutely. It's off market, and then all of a sudden, we make an offer, and they say, "Well, we got 3 other offers in," and so that you were not exclusive. But sometimes it's not true. We had a guy that was off that wanted $2 million for a property, and we said, "Okay, we'll offer $2 million, and we'll go into due diligence. We'll have refundable earnest money. We'll have a 30-day inspection or 40-day inspection." It's in a smaller market, and then he came back and said, "Hey, due to the amount of work that I've done to it, and all the new activity that I have, I want 2.25." And we said, "No, I'm not going to do it. We'll do 2 million." And I said, "Well, if he's put in 100,000 and he's asking for 250,000 in additional money," I said, "No, and I don't believe he put in 100,000 into the property." So we got to talking to the broker. Well, we're submitting a PSA at 2 million today, so he doesn't have any other offers. If he did, he would have just taken them. He was just playing that game. And it's a hard money lender who got the property back in a foreclosure and has owned it for a number of years, and it's 60% vacant. He's just running it in the ground.
Yeah, he does. That's not his job, right? He doesn't operate. So
they thought they could time the market, but anyway, it's another thing. But yeah, that thing that sometimes it's true. There is competition, and sometimes it's made up by a broker or a seller.
Yep. Well, good luck on that one.
Thanks.
I hope to hear in the future that you close on it and it's a good deal. So good luck. But yeah, it's an interesting market. I just love seeing those emails that says off market. It's like, yeah, it might be, but who else did you send it to?
And then on the top, your email alerts you that this is from a mailing list.
No, exactly. Yeah, you're blind CC'd on it.
Yeah, that doesn't look personal, but they say, "Hey, Shawn, I got this deal. I want you to really look at it. I know you guys looked at one down the road. Now we got an potential off-market deal." But even then, they're going to take it to 2-3 people. I mean, if I was a broker, I'd take it out as far as I can. I mean, 100%. Why wouldn't you?
And for the most part, as a seller, I'd want them to do the same thing, right?
Correct. Yeah. I
So
don't blame it. It's just
get
tough
it.
market. That's all.
Yeah, exactly. So if I hate the crystal ball game, but where do you see it in the next, 12 to 24 months?
I think we have more of the same for the next 12 to 24 months. I think 2025, 2026, we're going to be in for a wake up call, because even a 10% blip in the market or 20% blip in pullback in certain markets will kill a lot of operators. In fact, that'd make us probably lose some sleep at night, right? So I think we're in for another 24 to 30 months of this, it feels like. But I talk to a lot of people in the sign manufacturing business that do signs for commercial businesses. There's a guy that sells millions of dollars a year in that, and he says that he sees no end in sight with what he's doing. I see roofers that are doing new construction, and they say, hey, there's no end in sight to this construction. So it feels like we still have for sure through the next year or two, but I think 2025, 2026 will be so write that down, put it in your calendar. If I'm right, I'm a genius. If I'm wrong, it was a good guess.
All right, guys, we're all going to call Bruce when it gets there. I've heard similar things, though. It's just the pipeline, from the building standpoint, from the developing standpoint, it's just so full, and we all know there's a demand for it. We've all seen that the number across our screens multiple times, that there's a 4 million unit housing deficit. So we know the demand's there. Yeah.
And that's only one metric. I hear that a lot that says, oh, with this demand, the market can't go down. It's like, well, it can. If the interest rates go up and now you're paying 7-8% for Fannie and Freddie, trust me, those values are going to get hit. It's one metric to watch, but it's not the only metric. Just like you don't only watch interest rates, there's so many other things you need to look at to see what is really driving that.
Yep. And if what's unemployment at, what's wage growth at? Yeah, there's definitely a lot. And then you can get micro into your market too. Like, what are the trends? Is it, net population growth? Is it, positive population growth or negative? Yeah, I agree. And it'll be interesting to see where it goes. There's a lot of stuff. We all know there's a lot of stuff going on in the world and where it's gonna shake out. But as I tell people, I'm, a net buyer of real estate. So I will buy, at all times, as long as the deal itself makes sense. I don't know if you feel similar, but
yeah, you buy because it's a good deal today and it cash flows, and just put on some good debt so you can make it through multiple cycles, and make sure you're in a market like the oil industry right now is the oil prices are skyrocketing, and we'll see they'll be pumping oil out of the different oil fields across the country, and those submarkets will get very hot and they'll be very tight. But those ones, we could have a booming real estate market, and oil based markets could be plummeting. If the oil drops and gas prices drop back to $2 a gallon, we're going to see those oil communities, semi ghost towns. So you got to look at the micro economies as well. That's why some of the places like DFW seem to be safe. It's pretty big, stable market, ton of industry there. Phoenix has, been boom and bust forever. Is this time going to be different? Maybe. Some of the Midwest cities seem to have done well through the whole cycle. Not a big boom, but not a big bust either. In the last crash. So know your submarkets and what the industry is that's there. I thought education would get hit harder. I see people that are doing student housing are killing it right now, heading into the summer and fall. They got the next fall already. The student housing is full, and they got some good numbers coming in August. And I thought with people going online learning that maybe the universities would suffer, but the youth want to leave the house and go live on campus. It's going to be around for a while too.
100%.
But some of those things are good to know.
Yeah, 100%. We have a pretty good project in student housing that's, pre-leased already at 90%. So we love it, and it seems to be a resilient asset class. During the pandemic, for the most part, if you look at it, there was a period of time where the following year maybe the pre-leasing wasn't as good, but as a whole, that sector was really solid, even through the pandemic. And I don't know if you recently saw, Blackstone just acquired the largest publicly traded owner of student housing and developer of student housing in the country for $13 billion. So they obviously think it's a good spot to be as well.
Culturally, it's going to be around. I mean, online learning is going to go for people that are older, but for the youth, that college experience is really special, and it's here for a while yet. At least through this generation, there's no question that people want to leave the home and go to university, live that life. The whole experience is more than the education in some respects, right?
I agree. I learned more from just living on my own for the first time than actually in class. Maybe don't tell my parents that, but but yeah, and I actually went through college during the financial crisis. I started in college in '08, and so
Oh, wow.
that was also shows me that it was resilient, because I can't remember one person that had to leave school, at least of the circle of people that I knew, because of what was going on. Because you got to think about it, parents and or if you pay for yourself, you plan ahead of time before you're there. Most likely, you already have the funds squared away before something like that happens. So yeah, I think it's a great spot to be.
Yeah, no, it seems like it. I know people. I've done nothing in student housing. It's not our focus, but I know people that have hit. Some people got hit really hard during the pandemic. A couple of projects, but yet they're looking at August is already fully, going to be fully occupied, 100% occupied come August for the next school year, and it's still a 12-year lease, even though they're only there, 8 or 9 months. So it seems like a really good business model, and it's intriguing for me. I thought I was on that camp that said, no, we're going online. Everybody's going to go to online education, but I'm in my 50s. I look at the world differently and I never lived on campus. I did college. I didn't quite finish, but I did it in my mid 20s, and it was a different world. But I think culturally in the United States, it's here to stay for quite a while. It really feels like it. And it's a fascinating experience for those people that are able to live on campus from all over the world to congregate. I mean, there's diversity. It's just fascinating for me to see.
Yeah, I couldn't agree. All right, before I ask you the final 2 questions of the show, where can the listeners find you?
Well, the simplest way is to go to bakerson.com. That's BAKERSON, bakerson.com, because I'm a son of a baker. I'm an SOB.
I like that. Oh, that's awesome. All right, final 2 questions. The first, if you were someone who was looking to make the transition like yourself and go into more of, when you made that transition of going into more of longer term hold, what is there a piece of resource you would recommend, a book, a podcast, any type of education? Because to me, that when you're first starting out, that's the best piece of investment, is the investment in yourself.
I don't have a specific one, but the thing I shouldn't say I wish, because I don't look back because I'm not going that way. But the thing that I could have done better is build the power team, put together a power team, and understand. And one thing I learned, I've been in business 20 something years, and I just learned that a KP, a GP, and a sponsor is all the same thing in the minds of the lender. A key principle is everybody that's signing a loan. A general partner is anybody who's managing it, and a sponsor. So for all intents and purposes, it's the same thing. So build your power team, get some people that can really help you where you're lacking, and then you can help them where they're lacking. I would highly encourage that. It's a long answer, but that's what I would do
Awesome.
differently.
Well, you kind of answered the second question then, which has to do with, if you had a time machine and go back into time to your younger self. Since I have a finance background, I like to bring in personal finance to the show. What would be one piece of, financial advice you'd give your younger self that could, set your life on a certain track?
Oh, what I would tell myself, and this comes from deep within, is swallow your pride. Don't go it alone. Find a power team. Looking back, I'm just putting together a power team now. I've been in business for 20 something years, and it's pretty solo. And I realized that, man, I'm putting together this power team. I'm joining this group this year. It's pretty expensive to be part of. And it's something I never thought I would pay for, to be part of a mastermind group where we can build power teams to buy real estate. And I'm really excited about that. So yeah, looking back at myself, younger self, swallow your pride and don't go it alone, and build a power team.
I couldn't agree more. I joined a mastermind, and pre-mastermind, I was at about 25 doors that I built myself. And after joining the mastermind, in less than 18 months, I had over 390 units of multifamily and over 474 student housing beds. And
wow, congratulations.
And that's not owning a small fraction of them either. So, and that's not to brag. That's just to say it's possible, people. You don't have to give up everything. If you build the right power team, you can create some awesome stuff. So
because 50% of something is better than 100% of nothing.
Facts. Yes. And I couldn't agree more. So thank you for that answer. That's the first time someone said that, and I couldn't agree more. I beat on that drum all day long. Find a mentor and find a power team. Those are the 2 best pieces of advice I could give people that are trying to grow.
Well, my mentor for this long hold has 53 years experience in multifamily investing.
Wow.
And he's willing to take time. Anytime I ping him, he just said, oh yeah, let's get on a Zoom call. He's either in Phoenix or San Diego, and we get on regular calls. And he said, well, here's what you should read. Here's what you should do. Well, here's what I did. And 53 years, I should be listening to him. He's got billions of dollars under management.
Wow.
And he drives an Odyssey minivan and wears blue jeans and a button-up shirt. He's cool.
I love people like that. I hope to be in that situation one day where I can give back like that, because there's not a better feeling, and I'm glad there's people out there like that.
Yep. So I'm listening to him. I'm ignoring the noise.
I would do the same thing. Well, Bruce, thanks for the time today. I really do appreciate it. You brought a ton of value, and I can't wait for the listeners to hear this one.
Wow. Well, thanks for having me on. I really enjoyed it. And I look forward to the journey that, we keep in touch and see where the journey takes us, because this is it's an exciting time we're in. Good, bad, or indifferent. It's going to be exciting.
I can't agree more. I can't wait to see where you end up, and who knows, maybe we can be part of one of each other's power teams one day. So, Bruce,
welcome aboard.
Thanks for the time, and I'll catch you later.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.